Okay, let's try to continue the budget. The problem that we are working on earlier. So now we are going to do the budget profit statement and the cash budget. Okay? So I have pre-populated this Excel file so that we will not be spending so much time on encoding the different line items. So we'll start. So since you are able to compute sales budget individually in the earlier video, sales budget, production budget, and then you saw there the different requirements like the direct material requirement, the labor requirement, direct labor requirement, the overhead requirement. So we have computed it earlier. So we will just combine it all together to come up with the budgeted or the budget profit statement. So again, as I mentioned earlier, it's better for you to link the different sales formulas to each other so that when one number changes, like cost assumption, units assumption, or anything else change, the profit statement, your P&L, your balance sheet, or your cash flow will easily update or will easily follow. Okay, sometimes some people doesn't want to do that because it's prone to if somebody will change it, you don't know what changes has been made and things like that. But you can put some controls in your worksheet wherein you can lock it. It's only you who can edit it, or at the same time you can actually see the different changes, so you can monitor the changes, what changes has been made since the file was open. But I will not be discussing on that, but I will just focus on the budget profit statement and cash budget. So let's start with the budget profit statement with sales. Of course, everything starts with sales. Sales, we have computed it earlier, so that will be, so we have computed the forecasted revenue for Alpha and Sigma. So the total, so that will be forecasted sales, which is 8,500 times the unit selling price of 400. So that gave you the 3.4 million. So our forecasted sales is the sum of the total sales for Alpha and Sigma. So that's 3.4 million plus 896,000. Okay, so that's 4296. Let me just, okay. And to help us see it better, so sorry if I'm a bit OC on these things. Okay, and I want to have a comma. Okay, let me just close this. Okay, now the next thing is more on the another one that is given. Of course, we have to indicate here like what will be our beginning inventory in terms of the direct materials and then in terms of finished goods. Okay, I believe there is an amount of beginning inventory indicated in the given. So you see here it in the balance sheet. So this is given to us. The balance sheet was indicated, and then part of current assets include inventories for finished goods and raw materials. Now, we will first take into account the raw materials and then later on show the finished goods inventory. So for the beginning inventory, we will just get first the beginning inventory of raw materials. So that is 189,200. So I will go back here. I cannot link it there because it's a picture. So if you have your problem, given in Excel, it's better to put it in Excel. Unfortunately, I was not able to do that. So that's 189,200. I'm just sorry. It's 189,200. I cannot link it there because I can't. Okay, so moving on. And then the purchases, I think we have computed it here. The total amount of purchases is we have, let me highlight this one. So we have this computation of the equivalent units of material X and material Y that we need. So this is in units. But in terms of amount, it should be this one, direct material purchase, which is the sum of 839 plus 946. So that should give us 1,785,408. Okay. Let me get this. I'm so sorry if I'm so OC. Okay. Let me remove this one. So the sum of it is... Okay. Ayan. Closing inventory, no, I'll just leave it as it is. So the closing inventory is here. Closing inventory, direct material ending inventory is the sum of the 73,440 and 27,200. Okay? So to get the cost of raw materials, so beginning inventory plus purchases less ending inventory. So that is the cost of raw materials. Now, in terms of the direct labor, I think it is indicated here. So we have computed the equivalent amount for the direct labor. Let me just make it a bit bigger. Oh, I can't make it bigger. So 1.2 million plus 288,900. So 151,900. Now, in terms of production overhead, let me just... Okay. Let me make this a bit bigger, okay? As I go back, so the production overhead will be the sum of... So that you will see this one, the variable overhead for alpha, the variable overhead for sigma, the fixed overhead for alpha, and the fixed overhead for sigma. So that is 804,606. So for us to compute for the total manufacturing cost is the cost of raw materials plus direct labor plus production overhead. Okay? Let me just... Okay. Now, in terms of beginning inventory for the finished goods, we need this so that we know how much the total cost of goods sold, because we have the goods manufactured. We need to compute for the cost of goods sold because it is related to the number of budgeted sales. Okay, so beginning inventory for finished goods, I will go back to the problem. I mean the given to the problem wherein it says here that the beginning inventory for finished goods, I don't know if it can be highlighted. So inventories, finished goods, this is on the balance sheet. This is the ending inventory from prior period. Now, the ending inventory from prior period will be your beginning inventory for the next period. So, inventories finished goods is 99,076. So, we go back to P&L and then encode 99,076. So, again, I said that it's better that your FS, balance sheet, and all other things are all encoded in Excel so that you can easily link the formulas, the cells, and things like that. And then, beginning inventory plus cost of goods manufactured. So that is your total goods available for sale. Now, in terms of ending inventory, so how much is our ending inventory? I think it is here. Dito ba tayo? Is it here? Is it here? We have here the end. Oh, I wasn't able to compute it yet. Let me check if I have computed for I think it's not. Oh, but I think I have a computation. But I think so. Okay. I will have to compute like how much is the oh my gosh. um, how much is the cost per unit. Okay, so I have here direct material, direct labor, overhead. So the direct material for alpha is, how much is that? How much materials do you need for alpha? So material X times 7.2 plus material Y times 16. So that's your direct material. Sorry, I'm not able to compute this earlier. I forgot. Direct labor is, you need 10 direct labor hours times 12 GBP per hour. And then your overhead is this one, 3.2 times, this is related to the number of hours, plus, so there is a variable component, and then the fixed component is 285 divided by total goods manufactured. Okay. Sorry, I should have done this earlier. Now, for the sigma, the direct materials is 8 times 7.2 plus 16 times 9. There's actually a shortcut formula for this. I can quickly show. So instead of multiplying and adding it together, kasi ano naman siya, it's the cells are continuous. So pwede na tayo mag-sum product. We can use the formula sum product. So it means you get the sum of the product of the cells. So sum product of this and this. So yung what we did right earlier is 8 times 7.2 plus 9 times 16. So we can use the formula sum product, highlight the first selection and then the second selection kung ano yung mga i-multiply mo. So the answer is 201.6. So if you will remember, no, I was not able to. The earlier formula, so I manually multiplied the different cells, and then what I try to do is to use the sum product. So let me do Control Y. So, see, I used the formula sum product and then the amount is still the same, okay? So, that's one way to, halimbawa, you have a long list of column B and column C that you have to multiply and add all together. So, instead of multiplying each cell one by one, so you use the formula sum product, highlight mo yung isang cell and then highlight the other cell. Okay? Okay. Biglang nasingit yung ano. Now, in terms of direct labor is this one, 15 hours times the direct labor rate per hour. And then overhead is Department 2. We know that sigma, Department 2 serves or produces sigma. So 2.8 times the direct labor hours, because this is related to direct labor hours, plus the fixed overhead divided by the number of goods manufactured. So we're trying to compute for the value of the ending inventory, and for us to be able to compute the value of ending inventory, we should be able to compute what is the cost per unit for the items that has been produced. So in here, we will be using absorption costing. So if the problem is silent, use absorption costing. And then, so this is the total inventoriable cost. So going back, so now we have to understand how much is the cost of the ending inventory. So the total inventoriable cost times, where is the ending inventory of alpha? 1870. Okay, I think this is it. Okay, so the ending inventory, I can get the sum of this one and this one. Okay, 620 and 45. Okay, so your ending inventory is 665,984. Now, thus, the cost of goods manufactured is beginning plus, I'll hide this one so that you won't be confused. Oops. Okay. So cost of goods sold is beginning plus cost of goods manufactured less ending inventory. So that is your cost of goods sold. I can perhaps move it here so that we can flush it to the right as a reduction to sales. It's up to you on how you will move it per column so that you can easily see how much is pertains to materials, how much pertains to finished goods inventory. So we're not after formatting here, but more on the computation. Now, to get the gross margin, minus, okay, so our gross margin is 671.44. Selling and admin. I would like to split this into selling. I am quite critical in seeing the different line items. I wanted to see a separate line item for marketing, distribution as applicable, selling expense, administrative expenses, because this way we can promote accountability to the different department managers or the different department heads. Because if you just lump it all together, there's a tendency for them to overlook like what is their actual spend, how much is their actual cost for the period. Now, it's good that we have the granular details, though in terms of the overall presentation, you can present it overall as a selling and administrative expense. But as you review your budget, as you do your monthly variance analysis and understand what is the difference between actual budget and I mean between budget and actual cost, you have to be more granular on the details so that you can easily identify what are the items that has really caused that has driven the cost to go up or to go down and things like that. Okay, so selling, I will just link it, that one 236, and admin is 40,000. So having said that, we now have our budget profit statement. Excuse me. So gross margin minus, why do I keep on using the formula sum? So gross margin less the sum of selling and administrative expense. Okay, I hope you got the same numbers as I have computed. So we have the P&L. Now we can proceed with the cash budget. I think that's another requirement. Okay, actually the P&L is not a requirement, but it is necessary. I'm overemphasizing the necessity of having a profit and loss statement as you do your budget, because this is the essence of the budget. But we won't stop here, because equally important, or actually even more important, is the cash budget, because you may fall into the risk of technical insolvency if you're not able to forecast your cash well, especially if your collection period is longer than your payment period. So for example, the average time that you collect from your customers is, let's say, 50 days. And then your payment terms, the average number of days you pay your suppliers is 30 days. So there is already a 20-day gap. So you have to make sure that you will be able to make up for that 20-day gap. Okay? So that's why it's really critical that you should do your cash forecast. One of the things that we actually do in terms of budget preparation, we don't stop with budget OP. It will go further to operating cash flow, or there are different terminologies that is being used. So what we need to do is, yes, we should have to have robust assumptions in terms of accounts receivable. So we are always being asked, what is your DSO? what's your collection period, what is the amount of your capex and things like that, so that you can really see the operating cash flow. And it's really, really important because you don't want to run into risk of having technical insolvency. Okay, so I think the cash budget here is quite simple and straightforward because the cash, the receipts and disbursements is already given. But in the real world, this is not true. You have to assume how much is your expected receipt from the customer. So what I usually try to do is, for example, there is this sales amount. So we computed earlier, it's the total sales for the year. Of course, when you try to do your budget, it is usually on a monthly facing, sometimes weekly, and then you just have to add it all together to get the monthly facing. So most of the requirements, they ask you to have a monthly facing so that you can also see the different variations in terms of the up and down movement. Which months do you are bear months, which months are bullish, which months you anticipate that there is a lower sales and things like that. So that's how the budget really looks like. There's monthly numbers, and then there's monthly assumption on collections, there's assumption on payments and things like that. So in here, it is already given like how much is the receipts, how much is the payment, which is quite easy. In the real world, you have to assume how much you will receive from the customer. So for example, is your customer base all on terms, or are their customers on cash, or everybody else is on credit? Now, once you understand the variations on your customer base, so for example, if you have 100,000 sales in January, so if you are saying that 90% are on credit and 10% are on cash, so you can easily say that, okay, 10% is cash, you will be able to collect it on that month, and then we can assume that the 90% are on credit is same all throughout the year. So the 90% collection for January is coming from the sales in December. So those are the different variations that you have to take note, that the collection for the month is coming from the current month sales plus other months sales. So that's how you do the receipts projection or the cash projection. So it's really not easy. The problem is quite easy because it has already given you the assumption, but we will tackle other problems that, it says like collection for the month is coming from X minus 1, X minus 2, X minus 3 months and things like that, and also for the payment. Okay, so I'm overemphasizing the importance of cash budget, operating cash flow, because these are the things that are mostly overlooked by the management accountants. But this is even more important than your P&L, because I really believe that a sale is not a sale unless it is collected. So you have to make sure that everything that you put forward in your sales are collectible. I understand that there may be some customers that may default, but it should be an exception. And what is acceptable is very minimal, like not even 1%, 0.05% or something even lower than that. Okay? So let's do with the cash budget. So the opening cash will be the one that is coming from your balance sheet. So going back to the balance sheet, I think it shows here that your cash balance at the end of the year from the prior year is 34,000. So that's what we're going to encode here, 34. Okay? And then it says here how much is your receipts from the customers. Very, very easy. So that's 1 million. So I just got the sum of the opening and receipts to get the total receipts. Okay? Let me just... Now, in terms of payment, it's also given. So in terms of payment, you have to consider, like for example, what is your term with your supplier? Do you pay them 30 days, 60 days? Can you stretch it? I would suggest you stretch it as much as you can. So that's one way to manage your working capital, or really negotiate with your suppliers. Choose the suppliers who can give you the most credit terms. Now you also have to be cautious. Like if they're giving you cash discounts, more often than not, taking the cash discount will be better off for you, like in terms of getting the overall value of money. But we will just assume that there's no cash discount, so we'll just simplify this problem. And I think the problem is very simple because it already gave you how much is your quarterly payment. So you have to consider the different things that you have to consider on your payment schedule, or the payment for your suppliers, like in terms of materials. Of course, you have to make sure that there is enough budget for the payment of your wages. And then there are other relevant expenses like travel expenses, hotel accommodation, what else? Gasoline expense, water utilities, and things like that. So you really have to consider. And also, in terms of your tax payment, because you have your quarterly tax payment, you have to consider that as well, because those are the things that you cannot avoid. You don't have a choice, but you really have to pay BIR, okay, on a quarterly or a monthly basis, or whatever is applicable. Okay, so purchase of materials, it says here 400, payment of wages, other expenses. So it's quite simple. It already showed here that, so your total, let me just, total payments. Some call it payments, some call it disbursements. Okay. So your closing balance for the quarter is the difference between your receipts and your payments, okay? And your closing balance for Q1 will be your opening balance for Q2. So, I will just link the formula para nandiyan na siya lahat, ha? And this one should be... Okay. Now, how much is your receipt for quarter 2? Okay, you may ask, in the total column, why I use 34? Because your opening balance for the year is 34. Okay? So total is for the entire year. So your opening balance for the budget year will be your ending balance in your balance sheet. Okay? So just to not confuse you. So the opening balance is 34. Now, we go to quarter 2. Receipts is given 200. So, make sure that you already plug in the formula so that it will be easier. Purchase of materials payment is 480, 440, 100. So, your closing balance for Q2 is 94. Okay. And the next, so you just have to encode 1120. Purchase of materials 440, 480, 72016. In real world, it's not given. These things are not given. You have to compute it on your own, and you have to make different assumptions as to your payment period, collection period. And you have to consider as well if you have capex, capital expenditures, or you have payment of other things. As I mentioned, tax payments, dividend payments, loan payments, and things like that. So this is like an operating cash budget. Payment of materials, how much is that? 547984. 646,188 13642. Okay? Okay. Let me just Okay. So you can see here our cash budget for the year. So I just encoded the different assumption for receipts and payments on these columns, on these cells. Okay. And then, as mentioned, the opening cash balance is your ending cash balance on the prior year's balance sheet. Okay? So don't confuse it should be linked to Q4. Okay? So your opening balance is your Q1 opening balance, and then the closing balance in Q1 will be your opening balance for Q2. And then the receipts is you just have to add it all together, and then payments you have to add it all together. So your ending closing balance will be 199,170. So I think we more or less have the information needed to come up with your P&L. I will no longer tackle balance sheet. I will be doing other example problems that are more relevant. So what's really important here is for you to be able to see if your operating profit makes sense. So what usually happens is now that you have a budget profit statement, you should compare this to the prior year's actual operating profit. So what I always try to do is refer back to last 5 years. So I will show, like for example, if I am making a budget for 2021, I will have to show 2019, 2018, 2017, 2016, and 2015. So I will show what is my sales and all these line items up to operating profit from 2016 to 2019, and then I will show 2021 so that I can readily show the trend, ups and downs, rationalize the increase or decrease in some of the revenue or expense items. And at the same time, also important is to see the ratio of operating profit to revenue and the other cost items, the line items to the revenue, and also show what is the growth rate in terms of what is the growth rate of sales, what is the growth rate of operating profit, what's the compounded annual growth rate of these numbers. Those questions are always being asked, because the top management would want to see improvement on your sales, but more so on operating profit. I would overemphasize on the improvement of operating profit. I remember one of the ask and one of the things that I can proudly say that I was able to one way or another help make sure that our operating profit grows double digit each year. So I have been connected with a company wherein we're able to grow our operating profit 6 times in 6 years. So the compounded annual growth rate is more than 20%. If I remember correctly, it's around 25%. So it's really more on identifying the right customers, maximizing the profitability on those customers, managing costs, trying to understand which of these costs make sense and things like that, so that you can really grow your operating profit faster than your sales. Because in the end, what really adds value is operating profit and converted it to operating cash flow. Because in the end, as I mentioned, a sale is not a sale unless it is collected. So it doesn't make sense to sell something if you won't be able to collect it later on. Okay? And what really adds value to the business is when you're able to convert back this operating profit into cash so that you can reinvest it to bigger projects or to any other things that will add the most value to the company. Okay, I hope you learned something from this budget exercise. Thank you.